All right, so picture this. It's 2020. Markets have plunged. In fact, the markets plunged over 33% in just a matter of weeks. There was pure chaos, pure pandemic. Then fueled by trillions of dollars in stimulus, with the AI boom, the market soared right back. In fact, the S&P is up over 115% from those lows, sitting right around 7,000 points in today's 2026 market. What rallied? AI companies, exploding the global AI market, which is now projected to hit between $350 to $540 billion in this year alone, raising towards trillions by 2030. But household debt, what's at record highs? Right around $18.59 to $18.9 trillion in total debt. In credit cards alone, $1.23 trillion. The average interest rate on those credit cards, 19.6 to 23.79%. Now, inflation has cooled. We're right around 2.7%. Yet cash loses its purchasing power over time. This new world rewards those who invest wisely and don't gamble. Today, we shift from our previous episodes discussing savings and budgeting to how do you grow your money. The basics of investing. We're going to talk about strategies that win over long term and how to get AI exposure while managing risk. This is how you turn control into real wealth. This is how you begin your climb, and it accelerates right now.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
From episode 1, we discussed how COVID reshaped everything. Debt surged, inflation hit hard, but markets and AI accelerated. In episode 2, we build a foundation, tracking spending, budgeting, smart spending, the whole concept of 50-30-20 and zero-based budgeting. We discuss emergency funds, 3 to 6 months in reserves, and how to tackle high-interest debt first. Now, the payoff. Once basics are solid, and the basics we just discussed, emergency and cash is in place, high-rate debt shrinking, surplus money should work for you. Why? Well, very simple, because inflation at 2.7% erodes cash. Assets like stocks historically beat it in the long term. Compound interest is magic, for example. Consider this, $500 a month at 7 to 10% average returns grow massively over decades. In 2026, volatility still lingers. We still have geopolitical risk. AI is shifting jobs, but opportunities are abound. There are winners in investing, people who are consistently and systematically investing in the markets. And there are also losers, those who chase the latest hot topic, the latest insight, that set out because of fear, that those that are moved easily with their emotions when it comes to how they manage money. So let's equip you to win. Let's equip you to be successful. Now, I want to be clear with this. It doesn't guarantee that you're going to make money in the short term or even the midterm or long haul. What this is about is positioning your money in a way that you have potential to make money, to grow. And the only way we do that is by taking measured risk. Starting simple. Starting simple means investing by buying assets that grow or pay income. What kind of assets? Stocks. Now, let's remember what a stock is. When you buy a stock, you're buying a little piece. You're taking some ownership of a publicly traded company. Bonds, a little bit different. Actually, a lot different. Bonds are loans. Now, who are you lending money? Well, you can lend money to federal governments, state governments, corporations, even international entities. But the idea is that you're lending money. What other tools can we use? We can use things like ETFs, which is a basket of these assets that are mixed between stocks and bonds. They can be diversified or non-diversified. But really what it is just a basket of these assets that may be actively or passively managed by fund managers or asset managers. Now, when investing, there's a couple things we always got to take in consideration. Let's start with risk reward. Stock prices are higher today, potentially growing over time. The average growth rate of the S&P in the last years, in the last 10, 15, 20 years, has been around 10.5%. But remember, there's volatility. That doesn't mean that you're going to make 10.4% every single year. There are going to be years when the market has drawdowns. I'll give you an example. From December of 2021 to October of 2022, the average market downside was about 22%. Now, does that mean you lost 22%? Absolutely it does, at least in paper. And it becomes real if you sell during that time. And that's where we all struggle, right? When you look at your investment statements and you see, hey, I invested $100,000 in December 21 and now my account's at less than 80,000, it takes a lot of patience, a lot of discipline to say, I'm going to write that out. But we can't forget what we're investing. We're investing in the U.S. economy and U.S. publicly traded companies. Does that mean they're always going to do well? No. But that is the heartbeat of the system that we all believe in. Okay, so now let's talk about bonds. Bonds tend to be safer, right? Because there's less risk. There's less risk in lending money to entities like the federal government who potentially have reserves, assets, the ability to tax people, to collect revenue, and therefore pay their debt. Or corporations who, we can look at their finances. We can see what assets they have in case they don't pay back their or they don't have the cash to offset some of these costs. So the idea is that it's always more riskier to buy a stock, in theory, and I say in theory because there's always these outlier conditions, than to lending money. Okay, so it's safer, lower returns, but a key new rule. Never invest money you need anytime soon. Use your emergency funds for that. That's what they're for, right? I lose my job. I need to repair my house. My car breaks down. The last thing you want to do is be in a position where you have to pull money from your investments to cover that expense. What you want to do, and that's why we talked in the first couple episodes of the importance of having a reserve fund. You need those funds. You pull it from your emergency fund, not from your investments. Your investments is your absolute last choice. And if we're in a position where we're pulling money for investments to cover expenses, really got to take a step back and reassess what's going on here. Compounding interest. This is the real superpower. I'll give you an example. Investing $200 a month at just an 8% rate of return, starting from the age of 30, could grow to over $500,000 by age 65. You heard that right. If you take $200 a month, compounding at 8% annually, from the time you're age 30 to the time you're 65, you're going to have potentially over $500,000 accumulated. So start small, but be consistent. Like anything in life, consistency is key. What type of tools and accounts are available for you to do this? Brokerage accounts. They might be taxable, but they give flexibility, right? So you can pull money if you need to. You can add, you can withdraw, you can pause. They're liquid is the idea. 401ks is another option. Take advantage of your employer matching. Anytime your employer matches in your 401k, what does that equal? Cha-ching, free money. Always take the free money. Now, some employers don't offer 401ks. So we have other options, like what? Traditional IRAs. Traditional IRAs, remember, your contributions are tax deductible. So what does that mean? I made $100,000 and earned income in wages, and I put $10,000 into my traditional IRA. My taxable income is reduced by to $90,000. Now, very careful here. That $10,000 deduction is not tax-free. It grows tax-deferred. What does that mean? At some point when you retire and you pull money from there, you're going to have to pay taxes on those monies that are accumulated. So then the question becomes, well, then if I eventually have to pay taxes, then why do a traditional IRA in the first place? The answer is very simple. By putting money towards your traditional IRA, money that you would have paid in taxes, you're growing, you're investing, it's compounding over time. And the idea is that those $10,000 become $30,000, $40,000, $50,000, $100,000 or more. Okay. In a Roth IRA, because that's the other option you have available, you make after-tax contributions. In that same example, where you're making $100,000, if you make $100,000 and put $10,000 in your Roth IRA, you're paying taxes on the full $100,000. However, all the interest earned on that account and dividends and all the returns, 100% tax-free, as long as you do it within the parameters of Roth IRAs, and that's for a different episode. So with retirement planning, set it, forget it, be systematic, be patient, understand there's going to be cycles, and let the market become efficient for you over the long period of time. So let's talk about index funds and ETFs. There's different types of funds. Some are low cost because they might be more passive. Some are higher cost, actively managed. Some of those funds can track broader markets. For example, you can have an index fund that shadows the S&P 500, like VOO or SPY. And here's the interesting part. A lot of those passively managed funds have shown over longer horizons to actually beat those actively managed funds. It's hard to beat the market. The S&P is very efficient. The S&P 500 is an index of the 500 largest companies in the United States, and the way it's weighted really depends on how those companies are performing. I mean, there's a wide factors, but Warren Buffett is actually very famous. He's known for a very, very famous bet he made where he waged that an S&P 500 would outperform an active manager, and in fact it did, and he made some big money on that. So just consider that. Now, does that mean that all passive funds or passive funds in general are better than actively managed funds? No. Some people like to be tactical. Some people have better understanding of how markets work, and that's where you really got to ask yourself, what is your ultimate end game, risk tolerance, and strategy so that you can create the right allocation that's appropriate for you. With that, diversification. Don't put all your eggs in one basket. Having a mix of stocks, bonds, based on your age. Maybe you're younger, you tend to be more aggressive. You're older, you want to protect more your safety nets. You want to be more defensive, more conservative. Do you want some international exposure? Do you want to take measures in your portfolio to reduce risk? But remember, do you want to do it at the expense of what? Killing growth, killing income. There's always trade-offs with investing. There is no such thing as a one-size-fits-all strategy. I wish there was. We would all do it, right? If this strategy worked all the time, there would be no need to have so many strategies. But the reality is you really got to define three things. Number one, what is your risk tolerance? The more aggressive you are, the more you make when the market does well, the more you lose when there's drawdowns. What is your investment objective? What is the purpose of investing this money? Are you looking for income, growth, maybe a combination, capital preservation? And then finally, what is your duration? What is the time frame you're looking to invest? Is this something you're looking for the short term, mid-term, long-term? You take these series of factors and then you come up with your investment strategy. Another important tool that you can use, dollar cost averaging. What is dollar cost averaging? Well, that's investing fixed amounts regularly, for example, $300 a month, regardless of market conditions. So whether the market's high or low, you still buy and you still invest with those $300 every single month. When you buy more shares, and when there's so much volatility, what it does, it tends to average out pricing, right? I'll give an example. If something was trading at 10, and then at 7, and then at 15, by doing this dollar cost average, you're going to end up paying the average price per share for these positions that you acquire. So that reduces risk a little bit, at least in theory. With a long-term mindset, understanding the markets tend to be efficient over a long period of time. Perfect example, in the last 100 years of the market, 70% of the time, the market has been positive. And keep in mind that we're going to have dips. 2022 was a bear market, and the markets were hurt. But recoveries tend to follow. Historical data shows that holding investments for 10 plus years almost always, not always, but almost always shows positive returns. And then avoid pitfalls. Avoid day trading. Most day traders tend to lose, right? It's hard to really understand what's going to happen from day to day in the markets. Be fee conscious. Look at your fees. How much are you paying for your management? How much are you paying for these fees? Are you paying both a financial advisor, and does that financial have ETFs or other funds that charge fees? Because those fees can end up eating your returns. And then finally, avoid emotional selling and panics. The news of the day, something is happening around the world, some geopolitical risks, some concern that the market has that may not even be real. It just might be speculation. Financial markets, that can drive a temporary dip. While you panic, you're going to sell. And if you sell and it doesn't materialize, you're going to make a bad decision and have major losses. Now let's talk about section 4, the AI tech boom, and what are the opportunities. The COVID pandemic supercharged the AI boom. Remote work, data explosion, new vaccine modeling. Today, AI market is booming. It counts between $347 and $540 billion in 2026 alone. We're heading towards the trillions and expect AI to capitalization of over trillions of dollars by 2030. Companies like Nvidia, Microsoft, and others have surged. How do you participate safely? Well, you can never participate in markets completely safe, but you can minimize risk, right? You can reduce exposure to risk. How do you do this? Well, avoid buying single stocks, especially if you're not as versed in understanding the fundamentals of stocks and markets and how these things work. It's too risky. It's the idea of putting all your eggs in one basket. Great if that stock does well, right? Because this is called concentrated risk. If you concentrate your money in one position and that position does well, you can make a lot of money. But if that position doesn't do well, you can lose it all, right? Think Enron, for example. If you had all your money in Enron in the 2000s, you could say goodbye to all those retirement monies. Use ETFs, for example. If you want some exposure to technology, you can use tech-heavy ETFs. Something like the QQQs, which mirrors the NASDAQ, or broader AI themes ETFs that are diversified. There's even some like sector ETFs in the technology sector, some subsector ETFs. Look into those if you really want to do that. There's like a global space or microchips, and there's so many different sector ETFs or subsector ETFs within technology. And then consider this: balance with total market funds. Get some AI growth exposure without betting the entire farm on that sector. What tends to be the winners? People who are early into a boom, right? Those that bought Nvidia in the beginning in the pandemic, technology, microchips. Who are the losers? Who tend to be the losers? People who tend to chase hype and they ignore diversification, right? Oh, I want to buy into something when it's already done well. Well, you might have missed the boat on that one. But here's the great news. Since the economies are always innovating, revolving, there's always an opportunity. You just got to know to be in the market and be patient, right? So what are the risks? Well, the risks are, of course, market crashes. Temporary for long-term investors, but it can feel very permanent if you're a short-term investor. Take in consideration inflation. Inflation is another thing that can affect market returns and your risk. Your fees. How do you mitigate your fees? Well, make sure you're aware of how much you're paying for your services, and what's the appropriate amount of fees to pay. Listen, there's different opinions on this one. I think it really depends on how proactive and engaged your money manager is, right? Is this an active strategy where it's being rebalanced, it's being monitored, or is this more of a set it and forget it strategy? And your fees that you're paying should reflect accordingly. Okay. Diversify. Don't try to time the markets. It's very difficult to do so. And don't forget to always keep 3 to 6 months in cash reserves for the event that you need to cover unforeseen expenses. And retirement priority. Max your 401k. After you've done all the other things that we discussed, like paying down debt and having reserve funds. But matching your 401k is a good strategy, especially if you're getting free money for your employer. If you do 3% matching or contribution, and your employer matches another 3%, you have an instant return of 50, 100% immediately because you're getting double your money just for making the contribution. Then choose between traditional IRAs, taking into consideration tax break now, defer later, or Roth, tax-free growth once you retire. Base all this on your current and future tax situations. When do you think you're going to pay taxes? And this is a good question because I get asked often, like, should I do traditional or Roth? The question always comes down to, do I think I'm going to pay more taxes now or later? For those who are employees, who maybe have Social Security, a pension, their 401k, but most of their income comes from their earned income from their wages, well, it might be beneficial to take the deduction. On the other side, if you are a business owner or if you're already at a high tax bracket or low tax bracket and you don't see a potential shift in that, well, then it may make more sense for you to pay the taxes now. If you have debt between 7 and 8%, credit cards that you're paying 20, 24%, pay that down before investing aggressively. Why? Because math favors it. By paying off that debt, that becomes your instant rate of return on that money. If I had credit card debt at 20% and I pay that off, my return on that money now becomes at 20%. What are the common mistakes people make? Panic selling, over trading, not having a plan. Track your net worth quarterly and see how things are changing. And don't forget to celebrate your progress. When you hit your milestone, give yourself a round of applause. Be happy. If your goal is to save $100,000 or $200,000 or $20,000, whatever it may be, and you hit that threshold, congratulate yourself. It's not easy to do that, right? Remember, managing your money is not so much about how much you make. It's about having a strict plan, sticking to it, and having these little goals that we're constantly meeting, okay? New world has debt records, 2.7% inflation, AI explosion, but investing turns volatility into opportunity. You have the foundation from episode 1 and 2 to now, teaching you how to grow it. What are the action steps this week? Open a checking account, a brokerage account, a retirement account. Automate $50, $200 a month into index funds or other strategies that are appropriate for you based on your risk tolerance, investment objective, time horizon. Review your portfolio, diversify if needed. Consider, should I do a traditional IRA, a Roth IRA, where it's fit? And begin reading on things regarding to finances. For example, Vanguard Basics, Yahoo Finance, Google Finance, Bloomberg. So many tools out there to give you free information on how to navigate finances, how to understand systems, how to understand monetary and fiscal policy. So remember, you're not just surviving now you're building a legacy. The client rewards those who take calculated risk. Now, I do want to tell you all that this is general educational information. It's not personalized financial advice. Consult a qualified financial advisor to customize a strategy with you. One that's appropriate for you, one that takes in consideration your goals, your risk tolerance, your tax circumstances, because every person is different. There is no such thing as a one-size-fits-all. Thanks again for joining the climb. Let's keep ascending, and we'll see you next time.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.